All right, all right, all right. Good morning, good morning. How's everybody doing? First thing in the morning. All right, we got a good little crowd already waiting for us to get started. So that's good. It's nice to see you guys up in the morning on a third of July. 3rd of July. Can you believe that? So this is the mid-year. So January, February, March, April, May, June. That means that this is mid-year, July. So I thought we could do a portfolio review. Now we do a little bit of a portfolio review every now and again, and we come through and look and see how much money we've made. But I thought today would be a good day to go and check both our accounts, our our trading account, right, the one where we're trading options, and we'll just take a look at that real quick. And then, of course, I wanted to go over and look at our UBI, Universal Basic Income portfolio. And now the one that we have in here for the class, we haven't updated it in a little while. So we get to go update that and see if we've made any money. And then, everybody always likes to see my real money account, one of them anyway. So I'll show you one of my real money accounts and we'll review that one and see how we're doing for the year. Now, that one's a little screwed up because I started it in July of last year. So it's actually a full year. I will reset that one starting January and we'll have a new series. But because it was all new, that's the UBI portfolio, the Yield Max portfolio. And I've been pretty excited about it, I have to admit. I've been writing a lot of articles about it, doing a lot of research and study into how this thing works and learning a little bit myself as they bring new stuff into the financial markets. I like to learn all about them, and that's what the Yield Max funds were. I'm very impressed with them, as most of you know. And the reason is because it's just basically somebody else is trading options for us. And you know how much I like options. I love options. And so we trade our own options, but then it's nice to be able to take that money and put it into somewhere else and just let those guys trade them for us and do the distributions. And I've really enjoyed it. So we're going to go review that portfolio, the real money portfolio as well. So we'll just go take a look at that and see how it's doing for the year. I'm not as happy with it as I wish I'm not. It's not the, how should I say it? I got myself into some funds that I wish I wouldn't have, and I don't want to get rid of them until I've got to parity on them, until I get to break it. I can roll them into something else, and I have done that. I've rolled some in, and I've consolidated some, and we can talk about that when we get to that portfolio. But I don't want you to buy the things that I have in the portfolio just because I have them. And I worry a little bit when I show my real money portfolio. People go, "Oh, this is what Land has, so I better go get it." No. I bought these in July of last year, so it was what was going on July of last year. And some of them I've rolled, some of them I've kept that long. And so just because I pull up my real money portfolio and show you what I've got my real money in, I don't want you to just run out and say, well, that's a recommendation by Land. It's not. Markets have changed a lot, and I'm waiting to get into some other stocks. And we'll talk about that a little bit more here. But first thing I want to do is I just kind of want to run down through this month's portfolio. Now, I liquidated everything that we had in the market. I liquidated out. All right. So you can see that we're at one. Well, actually, I put one back in, but it's down $10. So no big deal. So you can see we're at $133,000. And about January, I think we started this account with $100,000 and we started trading options. Now, it's our educational account, so we screwed around. We did a bunch of stuff. We learned in it. But for the most part, we tried to make money in this account, right? I mean, we were doing our educational classes and we were learning about different things. But nonetheless, we're always trying to make money, even if it's like, well, let's put this on. It might not be the most perfect timing, but we're going to put it on because I want to teach what a bull call spread with a naked leg is. We'll go put a few of these on and, let's put one on in every account and just see what they do. But we've done pretty good with this little account. We've turned it into $33,000 mid-month. So that's 33% return on our money, right? A little better than 33% return mid-year. Now, if we could maintain that, 33% by the end of the year, we'd be pretty happy, right? If we could take that $100,000 and double that, though, go from 33 to 66,000, that'd be a 66% return. I think most people would be pretty happy with a 66% return. I know Doc Brown wouldn't be. He wants 100, 200, 500% return every year, right? But not everybody can make 500% return. So we're pretty happy with a 33% return right now. And by the end of the year, maybe we'd be up, when we have a full year under our belt, we'd be up maybe 66% return. You think we can hit that? Should we make that as our goal? Let's say if we can't, let's say 50%. Let's say we can make 100. That's pretty, I think that should be pretty conservative, don't you? If we've made 33,000 so far this year, we should be able to make another, if we said 50% return on our money, 150,000, I think we should be happy with that. So let's shoot that as our goal and see if we can't better that. Okay, do better than 50% return on our money. So make $50,000 this year on a $100,000 account. All right, so that's what we're going to do. And I want to go down through this. This is my 100% club portfolio, and I like looking at 100%ers. In the past, they've done pretty well for me. It doesn't always mean that just because a market made 100% last year, that it's going to make 100% this year. All right. But usually they're pretty good stocks that make that 100% run. Now, some of them have some oddities where they, they're little one-offs and they made 100% last year, but it was only because of this thing or that thing. But for the most part, if you look at the 100% club, they're usually pretty good stocks. You can usually get some good volatility out of them, and they're good to trade options on. So that's why I like the 100% club. So you can see I got a 100% club here. This is the 2024 100% club. These are all the stocks in the S&P 500, or not the SSR, excuse me, on the New York Stock Exchange and the NASDAQ. Those two exchanges are the only two I looked at. I didn't look at any of the small cap stocks or anything on the Russell or anything like that. Out of these are just out of the NASDAQ. Well, I guess, they're the ones that made 100%. On the NASDAQ and out of the New York Stock Exchange. So we didn't go over to the American Stock Exchange where the smaller caps are. So we stayed over in the NASDAQ, and that's what this is. This is just a list of the stocks that made 100% last year. Now, I started this stock list at the first of the year, and it got kind of muddied up because every now and again I'll open up stocks and I accidentally open them up into the 100% club, and that list gets really big. And then I'm like, all these made 100%? And then I'm like, oh no, I've kind of blended it with some that didn't, but were good stocks. And so I cleaned it out. This is the new list, or the list again, I guess you could say, that doesn't have all of my accidental opens in it. So we're going to start off, and I've gone down through some of these, and I've done a little bit of analysis on them, and done our count, measure, setup, trigger, and follow throughs. Done our probability count on them. So that's what you see on here where I've labeled everything. This is our probability count. So when we're trading the stock market or the futures market, whenever we're trading, anytime we are getting into the markets or getting out of the markets, we want to look at the probabilities of the market continuing, right? Now, there's a real fundamental basis to that, and I want to just review that very quickly for those who are new. And I want to just let you know that this is a lab for my university classes. Most of you know that, but this is the lab for my university class. I teach down at Utah Tech University, Southern Utah. And we decided to have a lab. Now, we teach our night classes, and that's when I teach. I have night classes, and I teach when the markets are closed. And that's no fun to teach a trading class when markets are closed. Not that it's bad. It's okay because it kind of forces us to do the academic work and not get kind of sidelined by, this squirrel here or this squirrel there. We get to focus in on the academic side of things. But the problem with that is we focus so much on the academic side, we don't have any trading because the markets are closed. Futures markets are open, so we will do a little bit of that. But for the most part, markets are closed. So I said, well, let's have a lab. And so we put the lab on YouTube because it just makes it available for everybody. You can come and watch it. You can watch it live. This is live. I mean, you're watching the real thing right now. But it also, because it's on YouTube, it records it for people who can't make the live class. They can come back and watch it later. And that's always nice. So, of course, just because it's a lab for the university doesn't mean that anybody around the world, because it is on YouTube, anybody around the world can't come and join us. But we don't go out and advertise, and we don't do all that stuff, and we don't try to get people from the world to come and join us. This is really for my students at the university. But if somebody stumbles across just wants to come and join the class, well, great. We love to have you. We love to have as many people as we possibly can get. It's always nice to have more people in the class, and that's for sure. So that's one nice advantage about being on YouTube, is that we get more people to come and join us in class. But we are in the summer session, so right now we are being a little bit lackadaisical, you might say, because we are in the summer session. We get more focused in the fall. We'll teach every single day. Right now, we're just teaching 3 days a week, Tuesday, Wednesday, and Thursday. And Wednesday is the afternoon session, so that's where we do a little bit of scalping and trading and day trading stuff during power hour on Wednesdays. But on Tuesdays and Thursdays, we do the morning session. We look at our portfolios. All right, and just kind of try to keep things on. Don't let the train go off the rail during the summertime. But just realize we're in a little bit of a lackadaisical mode, and we'll get more serious in the fall. Once again with our trading. Not that we shouldn't be serious with our trading in this summertime. We just realize that most people like to do more barbecuing than trading, and that's okay. But if we have our portfolio set up so that it just kind of takes care of itself, we don't have to really do a whole lot. We can just kind of come in and touch it and make sure everything's on track, and then let it run, let it do its thing. All right. So not so much day trading, but a little bit more position trading or long-term investing. And that's the nature of the beast. All right. So right now, the 100% club, we're going to come down and we're going to look at the probabilities of trading. Whenever you trade, the probabilities, whenever you trade, you need to know and understand the probabilities. It's like going to Las Vegas and sitting down at the blackjack table and not knowing the rules. All right. If you don't know the rules of the blackjack table, or you don't know what the odds are, you're not going to be a very good blackjack player, right? You might stumble across a win or two, but for the most part, in the long run, you're not going to win. The guys who are sitting at that table and who know the rules and know the odds, they're going to win. All right. They've got a little bit more knowledge, a little bit more skill. Now, not that necessarily that the financial markets is like gambling, but for the most part, there's a nice correlation there in the sense that we can look at one and apply different strategies to the other, simply because there's all about trading the odds, right? We want to know what the odds are. And I'm going to give you just a little structure here. I'm going to draw something for you on the screen to give you a little structure and understanding of how you know the odds. Now, this is all coming from past performance, right? Past performance is not necessarily indicative of future results, but it's the best we've got. And if you go back, and a lot of people have studied this, it's all written in books and all kinds of stuff. And I've written a book about this. And so you can study and learn this stuff. It's called the accumulation distribution model. It's also called the Elliott wave and Fibonacci. This is how we identify the probabilities. All right. Now, there's lots of things you can stack on top of that: recurring price patterns, indicators like RSI and MACD and CCI, and all kinds of really fun things that you can do to augment this. I'm not saying that this is in place of that. This is in addition to. But you need to understand, when you build a house, you have to build a foundation and you have to build a structure around it. Okay. And then you can put the roof on and you can put the furniture in it if you want to, and you can have all the niceties, put the pillows on the couches, but not, you don't start off running around looking at pillows that go on the couches when you haven't even got a foundation yet. You have to start with the foundation, and then you can eventually get to the pillows on the couch. All right. Don't start with the pillows on the couch. And the problem is, when you go out and you do these YouTube videos and you look around and you're surfing for, how am I going to get rich beyond my wildest dreams, in the stock market? And you go to all these YouTube channels, they're going to show you the pillows on the couch. All right. So you got to be really careful and realize what their places are in the whole scheme of things. So what we're going to do is we're going to understand the markets move through waves. All right. They go up and down. Is that not too hard to understand, right? Markets have a tendency to rise and fall. If I was to ask any of you to go up to a chalkboard in class and say, draw me a chart, most of you would draw something like this, right? You would draw a rising market. You'd say, well, they go up and down like that. Nobody would just draw a straight line. We know intuitively that markets don't just go straight up. They go up through waves like this, right? Now, this is a pattern. This is a reoccurring price pattern that occurs over and over and over again. It's very common. It's very ubiquitous. Look at this. Markets go through waves, right? Up and down, up and down, up and down, up and down. Whether it's on the downside or whether it's on the upside, they go through these little wave patterns. So what we want to do is we want to recognize that and realize that through past performance, we have a way of understanding that these markets have a tendency to do the same thing over and over and over again. And what they do is they generally like to make 3 drives: drive 1, drive 2, drive 3, before they get to the top and make a little retracement. All right, and come back down. So this is a pattern that we look for. Now, it doesn't happen all the time, but it happens often enough, and it happens more often than you would ever imagine. It happens often enough that we can trade it. All right, and this is where our probabilities come in. So it's really hard for us to identify the first drive 1 right here. This is what I call the A1. So this is the A drive, this is the B drive, and this is the C drive. Not real hard, right? Real easy labeling process. Now, there's more sophisticated ways that people will trade this. Some of you may recognize this as an Elliott wave. And an Elliott wave is actually, if you want to look at the traditional way, is X, 1, 2, 3, 4, 5, A, B, C. All right. So that's a traditional Elliott wave pattern. And if you go and you look at the Elliott waves and you learn about Elliott waves, this is what you're going to learn about. Now, don't get all scared because it sounds like a big fancy name. It's just a guy's name who came up and wrote this down in the book for the first time. All right. It's not like Elliott waves or this thing, this big man. No, it's just some guy named Elliott came in and said, hey, I figured out that these markets go in waves. And everybody's like, duh. And so he went down and wrote it down and said, look, I've got all these examples of where these markets do this. And so now there's an Elliott wave book out there. You can go buy it on Amazon. It's about that thick. It's like an encyclopedia. I always tell everybody, just take the first chapter and tear it out and throw the rest away, because the first chapter is really all you need. The rest of it is just excuses on why it didn't work, right? It's just a lot of excuses on, well, when it doesn't do this, it did it this way here and did it this way here and did it this way here and did it this way here. Just a lot of excuses as to why the standard traditional method didn't work. And that's okay. I mean, it's a library of information for you to understand different methods, and and that happens often enough that they've got all these little rules that you can use. But for the most part, just to keep it simple for us, we don't need it to get too rocket science-y. We just come in and we realize markets have a tendency to move in waves, 3 drive patterns, and that's what we really look for. Now, because markets are what we call fractal, meaning that they make big little drives inside of big drives, right? We can come in here and we get these little drives too. So we come in and inside of the bigger drives, we get smaller drives. So we can go in here, we can go A, B, C, D, E, F, G, H, I, J, K, L, M, N, O, P. It's not that hard, just ABCs, all right? So we get little drives inside of big drives. And if you want to count it with the Elliott wave tool, you can do it officially like X, 1, 2, 3, 4, 5, A, B, C. All right. So, and then we'll get another one, A, 1, 2, 3, 4, 5, A, B, C. All right. So that's how Elliott waves work. And because of that, I'm going to take these off just to clean it up a little bit. We have to look for these little patterns. All right. So we look for the bigger patterns and the smaller patterns. And the way I label this, I just come in here and I say, this first drive is an A1. It's just the first entry for the first drive. Now we can use indicators to help us do this. And I use an indicator called the blue light system. It's based on the parabolic SAR. So if you have parabolic SAR, if you don't have track and trade, then you can go get your shitty program that you don't, that you probably got for free, and use that one. And it probably has parabolic SAR in it. But I use one called the Bulls and Bears, and it's a little bit toony. It's tuned in a little bit different. So you can use the software I use, or you can use your own software. But if you want to use the software I'm using, just here real quick.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so I'm partial to this software, all right, obviously, because I was the one who developed it. All right, so we come in here. So that's the A drive, and then this is the B drive, so this is called B1, right? Makes sense, right? And then this is called the C drive, so this is C1. C1 just means it's the first entry opportunity getting into the C drive. This is the first entry opportunity getting into the B drive. This is the first entry opportunity getting into the A drive. So that's the A drive, the B drive, and the C drive. Now, very simple. Now, coming down the other side, we just count it going backwards. But I'm going to leave that for now. We'll just talk about the long position. I don't want to confuse you with the short sides. All right. But we're going to come in here. And then because we have these little fractal drives in here, right? Let's come in here very quickly with our little fractal drives. And for some of you, you've seen this before. Just let it be a nice little review for you. And then we'll get onto the real market, and we'll look at how these are working in the real markets. All right. So here's the little miniature fractal drives. So then we come in here and say, well, the market rallied and then it pulled back. So that becomes the A2. And then it did it again. So now we call that the A3. All right. So this is your probability of the market moving up through these little drives here. So it comes down here, and when it dips and starts to rally, first green candle to make a new high, that's the A2. Then first green candle, make a new high off that little dip, that's the A3. Now, it doesn't mean it can't do A4, A5, A6, A7, 8, 9, 10. It certainly can. And it doesn't mean it can't stop at A1 and A2. I mean, it can make one little drive and that's it, right? So we often say don't chase the A1s because you get a lot of false breakouts on A1s. That's just kind of choppy markets, right? They don't just take off and make nice, beautiful trends, and you get lots of false breakouts. So we oftentimes don't chase the A1s or try to get on A1s. We'll wait till an A2 or an A3 or even a B1. All right, so we don't like to get in new on an A3 because you can see why. Well, it's getting up there to where it's topping out before it turns around and starts to come back down. So we don't like to enter the market on an A3 at the very top. Now, some of you know recurring price patterns. You're like, well, Lan, I was taught all about triangles and wedges, and I learned about head and shoulders formations. How does that work into this? Well, it works into it just fine because they're all part of the system. So down here on the little one, you can see this is a little head and shoulders, left shoulder, neckline, head, neckline, right shoulder. So that's your little head and shoulders down here on a smaller time frame, but also you'll notice that this is a left shoulder, this is a neckline, this is a head, this is a neckline, this is a right shoulder up here on the longer term time frames. All right, so everything works copacetically inside of this system. Oh, what about my wedges and triangles, Lan? I've taught all about wedges and triangles. Well, these are this is where you're going to get your little pennants. So your little pennant formations come in here. All right, so this is where you find pennants. And then you get triangle and wedge formations that can be larger. They can come in like in these locations here. All right, so that's going to be your wedges and your pennant and your triangle formations. You can also get larger ones like this. You can come in here. Let me draw it this way. You can get your larger ones coming in this way. So there's your pennant and triangle formations on the longer time frame. I'm going to draw it better. There we go, like this. All right. So those are your triangles and wedges, and then you also have your smaller ones. So those are where your little pennants and flags are. All right. Pennants and flags are the smaller ones. Triangles and wedges are the bigger ones. So you have different sizes. We call it fractal. All right. So that's how you look at these different markets, and that's where your different recurring price patterns come in. Okay. And then you can say, well, Lan, I learned all about trends. What about trend lines? Well, trend lines are pretty obvious in here too because they're part of this same structure. So you can see you got one nice big long trend line up through there. There's your trend line for the longer term trend. You've also got shorter trend lines coming up through the smaller ones like that, right? So we look at the smaller trend lines. We can look at the larger term trend lines. All right. And then we'll notice that we get three of these larger drives, right? Three drives. So I call them mountains, 3 mountains. We call them 3 mountains. So here's when you got your nice big long trend line, we generally get 3 mountains, right? There, 1, 2, 3, just like that. There's the second mountain right there. And then we get the third mountain right there. And that's where we come up with what I call my little 3 mountains, which is just the 3 drive pattern going up this. All right. So we call that the A1, A2, A3. And then we start over with the B1, B2, B3. And then of course there's just to top this off, we have a little structure in here. Let's get rid of our mountains and our triangles and wedges. All right. So we have this little structure that comes right in here where the market pulls back. And there's 2 points we want to make here. First of all, we like to look at what we call the cone of probability. And that's this right here. This is the delta cone of probability, calculating the delta cone of probability, which is actually, you're not going to, if you go out and search on the web and say, I wanted to see the delta cone of probability, it's not going to pull up. All right, because the real name for it is the 68-95-99.7 empirical data distribution rule. All right, that's the little bit more professional version of it. I called it the delta cone of probability. That's my name for it. All right, but approximately 68.2% of the time, the market stays within 1 standard deviation. So if the market leaves the 1 standard deviation, it likes to come back to the 1 standard deviation about 68.2% of the time. 95.4% of the time, it falls within 2 standard deviations, and 99.7% of the time, it falls within 3 standard deviations of the mean. So if we take this concept and we go back over to our chart, right? Remove, add. We go back over to our chart, we have what we call a Fibonacci ruler. Now, many of you have heard of the Fibonacci ruler, but most people on the internet are doing Fibonacci rulers wrong. So not that they're doing them wrong, they just don't understand them in the full structure of things. But what we're really doing with the Fibonacci rulers, we're just measuring these waves, right? Markets have a tendency to rise and fall and then come back to the mean, the 1 standard deviation, which is the distance between that 38.2 and the 61.8. So markets rise, we measure the first rise, and then we measure the pullback back into this mean. That's why we measure the Fibonacci ruler. That's what it's for. It's to measure that one standard deviation. So we're looking for the market to return to the one standard deviation. Once it does that, we like to be buyers down in here, buy the valleys and sell the rallies, and we look for the next rally up. Now, if it's going up here, we don't want to necessarily be doing this on the third drive, right? Why? Because the probabilities of this thing rising up out of the third drive, it comes up, it pulls back down into the Fibonacci sweet spot right here, and then it starts to rise, but we don't want to be buyers there because it's not very likely that it's going to go up and create a fourth drive. Now, doesn't mean it can't, certainly can. And I show you some markets that do, but it's rare. All right. It's really rare. So we don't want to take rare trades because we're just little teeny small speculators, right? We're a gnat on an elephant's ass when it comes to trading. We're just so tiny that we don't really make a big difference. So we can't move the market. We can't manipulate the market. All we can do is get on the elephant and ride, right? So right down in here, we don't want to ride into something that's got a real low probability of success. We want to get in when we have a higher probability of success, like down in here, on the B ones, the C ones, getting up in here. That's not a very good opportunity right there. So we don't want to be long buyers right there. So this is the nature of the beast, and this is how you need to understand it. Now, these little Fibonacci rulers can be used over here on the fractal side as well. So we can measure from here to here, right? Little pullbacks. So we can measure those little ones too. The problem is sometimes we get so focused on the trees that we forget about the forest. All right. We want to always remember that there's trees within the forest, and that there's a bigger trend and there's a smaller trend. We get kind of myopically focused on the little tiny trends sometimes. We forget about the overall longer term trend. So we got to keep that in mind that, yeah, there's little ones, but there's also bigger ones. And so keep that big picture in mind. So what we're doing down here is we're coming in between. One more thing I want to show you before we go over and start doing this on the real market is I want to show you that right between these points here, all right, these little pullbacks where we're coming back into the Fibonacci sweet spot, and then we're looking for and calling out the C1. Where's the C1? Where's the B1, right? So what we do is we come down and we anticipate that the market's going to pull back into this Fibonacci sweet spot or into the delta cone of probability or into the one standard deviation, right? And it's going to come back down in here somewhere. And this is where we can start to look to be buyers. Well, there's a number of different places for setups and triggers that you can use. Now, this is where you can use some of your indicators. They're going to help you identify places where markets might want to get in and get out, that kind of stuff, right? This is where your RSI is going to help you. This is where your MACD is going to help you. This is where your moving averages are going to help you. This is where some of your setups and triggers are going to help you, all right? But we're going to come in here, and I like to look at something called, I call it the spider web, but it's just natural trend lines. And we can use a little tool in tracking trades called the speed fan, all right? So you're going to come down here, you're going to draw the little speed fan. Now, this is going to be the first entry point, the breaking of the natural trend line. It's your first entry point. It's a little bit lower probability because you could get some false breakouts, all right? So you're going to click that one. That's your first one. The second one, which is what I call the true C1 or B1 or A1, which is the mathematical model or the crossing of a mathematical model or an indicator, which in this case is the blue lights. So when it crosses the blue lights, that's your C1 in this example, or down lower in the B1. And then you got your horizontal now, which is the previous high, all right? So the reason I think that is important right there is because that's what we call the previous high, which turns into being what I call the Fibonacci bow tie. All right. So that becomes resistance at the first point right here, resistance. And anytime anything breaks above a previous high, lots of people like to buy on those right there. Now, I like to be in already down here. I like to be taking profits at that point, but lots of people like to buy at that point. Now, this ends up with a pattern that we call the Fibonacci bow tie. All right. So we take this point here. We measure down to the Fibonacci retracement, down into the Fibonacci sweet spot, back up to this point here. Now, see that becomes a triangle. So if we tie that off, that becomes a little triangle right there, right? Now, this is geometry, all right? So remember your high school geometry, and this is where you're going to work with your geometry, all right? So you got this little triangle, and then we're going to get a little flip triangle, a little triangle going the other way. Now, the distance between this B point and this C point should be equal to or close to the same as this triangle here, all right? So we're going to get a reverse triangle like that, all right? So the market has a tendency to rise up to the previous high and then go a double again same distance, up one more time. And then it has a tendency to pull back to the delta cone of probability, which is generally this previous high right here. And that makes what we call right here, this is the Fibonacci bow tie. You can see it in there like that, all right? So that's turning resistance into support. Now, you've heard that before. If you've been trading any amount of time, resistance becomes support. So that's how that works. And you get one more right down in here. Here's another little bow tie. We take our little bow tie tool right here. You can go this one, this one, this one, and it ties it off at the bow tie right there. So you get two little bow ties inside of your longer term trend, just like that, right? Little triangles and wedges. Now we got tools in here, Fibonacci tools that we can use to measure those and count those and see where they're at in those different Fibonacci bow tie trends. All right. So we want to measure those with our tools. So that's why we call it a Fibonacci bow tie, because we use Fibonacci ratios to measure those bow ties. Now, this all sounds like, oh man, Lan, now you're starting to go over my head. No, it's really quite simple stuff. And you're going to see how this works when we go down and start looking at a real market. It's not always this perfect. Obviously, this is a model that's right out of the manual. The manual? What manual? Oh my gosh, of course we got a manual. Where is it? It's on Amazon. You can go get it, search Lan H. Turner, and you're going to find a manual out there. It's got all this stuff written down in it. All right. It's got all these probabilities in there. It's got probability tables. It's got examples. It's got everything in there. Just go search Lan H. Turner on Amazon. You have to put the H in there. If you don't, who are you going to get? Lana Turner. She's very pretty, but she's not going to teach you how to trade. So you got to search Lan H. Turner, and there's a couple of versions out there. Get the one that has it's got a little chess piece on it. All right. Little chess piece, like chess. So it's got chess pieces on the cover. So just go get your book, and that'll be the manual for the class, and it'll have all this, like 280 pages of full color, 8.5 by 11. It's a real nice soft cover, so you can lay it out on your desk and read along with it. All right, it's got all this stuff in there and all the probabilities. All right, so there you go. That's how we're going to work and go look at markets. Now, this is your foundation of your trading strategy. All right, so anytime you look at a market, you want to look at the foundation, the structure. All right, so this is the structure. This is like building a house. So we're going to come down and we're going to look at a real market. Now, this is how we label these. As markets come down, this is the downside. There's something I didn't label up here. There's something else I want to show you. Well, we can show you down. Let me clean out all. Well, I don't want to clean all this stuff because then all these will go away. All right, so here's how I've come through and I've labeled these for us on the real market. Now, as the market comes down off the top of one of these big high peaks, that first crossover right there is what we call the X1S A1. Now, you recognize A1 because I showed it to you up there, but X1S is a little bit different. So we come back up in here. As the market comes up, we have these trend lines, or the little blue lines, right? The little blue dots. And the little blue dots are nothing more than mathematically calculated trend lines. But when the market breaks those little blue dots, that spot right there, right? That spot right there, that's called X, all right? X for exit. It stands for exit. Exit. Now this is the B drive, so this is exit 2. Down here, this is the A drive. So as it crossed and started to come down off that little ABC top, that would have been exit 1. Exit 1. And then just to make it simple and easy and not to clutter the screen, I come in here and I just simplify that and call it X. All right. So X, this would be X3. So an X3. So exit 3. So that's our third exit on the C drive, right? Because you get 3 drives, you're going to have 3 exits. And you're going to have 2 drives, you're going to have 2 exits. You're going to have 1 drive, you're going to have 1 exit. So I just call it X, all right, to keep it simple. But it's your first exit on the A drive, your second exit on the B drive, and your third exit on the C drive. So now when you're coming down the other side, you have to count it backwards, right? So if this is the A drive going up, well, this would be the A drive coming down. So I just put it right in here and count them. Oh, let's get rid of that. Put them right in here on the same window. So instead of calling it an X3, I call this an X3, and then coming down the other side, it's the A1 coming down the other side, but it's a short side. It's not the long, so we have to put an S on it. So I just tag it with an S saying that, hey, that's the A coming down the other side, the A drive. So it's an X3 exit, third exit to the long side, the C drive, X3S or X3A1S. And then this one coming down this side, we would be right here. So we would get a little exit point in here. And this would be our X It would be actually we'd coming down the other side. We just call it the B1S. All right. So we just call it B1S. And I know it starts to get a little bit, you're like, I'm a little confused. That's why I didn't want to do the downside first. So, but we have to talk about the downside because that's how we know where the upside starts, right? Because when the downside ends, we get the upside. So if you come down here, this is where we got the X1S. So it's the first exit to the downside. So that means this one here, we're going to just assume this one over here is going to be the X3S or X3 slash A1S. I know. It starts to get a little bit, but in the book, in the manual, you got all these tables that show you how to do this and lots of examples. So that's the X3. So we're going to say that's the third drive to the top, A1S, short side, first entry, short side. Down we go. And then we get out when we cross the blue dots. So that gives us an X1S. So it's the first exit to the downside, and it's the short side. And then it's also the first entry to the long side, A1. So that becomes what I call an X1SA1, which has a really low probability of making money to the long side. It's a low probability. We don't ever want to take X1SA1s, all right, because it's very high probability that that market is just going to pull back to the standard deviation on the way down. So we put our Fibonacci ruler in there and see how that came right back up to the 38.2. Right there at the beginning of the standard deviation. There's our whole one standard deviation right there. It didn't quite go to 50, but it hit 38.2, which is really common. All right, that 38.2 is a very common number. And then it flushed one more time. That gives us an X2SA1. Now, I like X2SA1. Those are good. I'll generally take an X2SA1. Now, I won't take them with a full Monty, all right? I won't back the pickup truck and sell the house and sell the kids, but on an X2SA1, I'll put something in on that one just in case, because that's usually a pretty good entry point. But doesn't mean it can't come down and give us an X3SA1 down here. So if we get an X3S, X3S, A1 down here, now that's the one where, depending on the stock, right? Of course, we're not going to be taking a stock or watching a stock that we don't want to be in anyway or have good confidence in. But if we hit an X3SA1, I'll pretty much back the truck up and sell the farm, right? Sell the kids, sell the farm, sell the truck, sell the cars, and buy whatever this stock is here at X3SA1. That's a real high probability of being successful. Does it mean it can't come up and bite you in the ass and go down and do an X4SA1? No, certainly can. It's all probabilities, but the probabilities tell us that those are the really good locations to be buyers at. X2SA1, that's pretty good. Not bad, all right? Better than 50%. These down here, you're getting up into 65, 75%, 85% chance that's going to rally and be the bottom, all right? You're getting really high probabilities that these markets, so when they get down off of a 3 drive down, that the market's going to go. Now, there's also the accumulation distribution stage. Big, huge companies like to run these things sideways down here a little bit. So not always is it a perfect break and a perfect rally like you're seeing here. Sometimes they come down here and they go through what they call the accumulation stage, all right? And the accumulation stage where the market will bounce up and down a lot down in here. And they do that on purpose because they want a lot of shares, all right? And so they're accumulating big shares and the market choppy because they don't want it to take off and run without them. So they do a little what they call the accumulation, where they'll buy 10 and they'll sell 9, buy 10, sell 9, buy 10, sell 9. But causes the market to bounce a lot. Now, I'm using 10, but they use much larger quantities, obviously. But they end up with a nice big holding of positions without actually running the market. It's called the accumulation stage. It's beyond the scope of what we're talking about now, but just understand that markets have a tendency to go through these accumulation and reaccumulation stages. And then they also go through distribution stages. So big firms like to do this, all right? So be mindful of that. They don't always turn and run like this. So that's why we like to use options, because options have a little bit longer time. You know, they've got limited risk. Oh no, look what I just did. I just accidentally deleted all those. I wish it would pop up and say, are you sure you want to delete all of them? But it doesn't. Oh, I deleted that one too. All right, well, let's delete them all. All right, they're all gone. Okay, so what are the indicators I've got on here? Well, I've got on here, this is called the Donchian channel. And the reason I put the Donchian channel on there is because I'm lazy. All right, I've got, if you look at my Donchian channel, these are my settings again. I have the Donchian channel set to 100. If you hit TNT defaults, it's not these colors and it's not this time frame. And it's not this offset. I just offset it by 2. But the period is something like 20 or something. I like it on 100 just because it gives me the longer term the overall longer term view. But what that is just kind of, for me, it's just drawing the Fibonacci ruler in there so I can see where that center line is. So that red line on the Donchian channel is like 50% of the Fibonacci sequence. All right. So that's all that is. And then this is the high of the previous high, and this is the low of the previous low of the last 100 bars. It kind of gives me a good roundabout Fibonacci number, Fibonacci sequence on there. So I know where the one standard deviation is of the entire bigger trend. All right. That's why the Donchian channel's on there. It's just because I'm lazy and I don't want to always be drawing the Fibonacci ruler. So I can turn that on, turn it off, gets it too busy. But that's why that's there. All right. It's for my Fibonacci ruler. So you can use that. And then this one right here is my 200 period moving average. Now I like 200 period moving average. This is just the simple moving average, 200 simple moving average, which is used very strongly by a lot of big quant firms. All right. A lot of big companies use the 200 period moving average as an area of support. All right. So it's always considered that if the market is above the 200 period moving average, it's bullish. If it drops below the 200 period moving average, if the 200 period moving average and the market comes in, it starts using it as resistance, right? So the 200 period moving average, if it's below it, can be resistance to the upside, support to the downside. Just like we were mentioning before, right? Support becomes resistance, resistance becomes support. So that 200 period moving average is a very strong target point where markets will have a tendency to draw down to, using it as support, and then it'll bounce. And as long as it stays above that 200 period moving average, we can consider the market being bullish. All right. Now you can come in and look at the 100, or you can look at the 50 period moving average. You can look at some of these other period moving averages, but the 200 is the most important. All right. Always remember 200 period moving average is the most important for the longer term trends. Markets have a tendency to use it as support. All right. So that's what we're looking at here. Now, this blue light is how we count the waves. So as the market comes down, this is the mathematical wave count, right? So this is the top, A, B, C. Remember the little A, B, C pattern. So we come off of here, A, B, C, D, just like that. Little ABC pattern. All right. So this is the first wave. This is the second wave on the way down. Now we turned around, we went back up. So this is the first drive, this first drive, it broke the blue light. So we're going into the second drive. All right. Now this one's coming in and doing a little funny thing here that I want to talk to you about. But this ends up being right here. This is the A1, right? So this is the A1. Now it's actually, if we want to be more sophisticated, it's actually the X2S A1, X2S A1. Now, X2S A1, again, we like. Now, we're going to come in here with our speed fan, and we can just draw our little trend lines down here. Now, the natural trend line seems to be coming down about right here. So if you're just going to trade the natural trend line, that would be your first one. This is your natural. This is the actual A2 where it breaks the blue lights. Then you got your horizontal, which is way up here, which is where we're looking for that Fibonacci bow tie, right? So now that's our two entry points. So you could call this one the A1 right here, or you could call this one down here A1. Either one, it's up to you. But I always put this one on as A1, and then I sing the little song, down in the valley so low, because I have such a beautiful voice and people love to hear me sing. And so what I do is, just as a reminder, that the little valley prior to the blue light crossing is generally the first A1. All right. So we call that 1, 2, and 3 opportunities to get into the market. It's just an earlier entry. And if you take it, just realize that it's not a confirmation that it's crossing the blue light. That's the mathematical model. That's the confirmation of the one down here. So you can get in a little bit earlier down here on a breaking of the natural trend line, a breaking of the mathematical trend line, or breaking of the horizontal trend line. Now, we don't want to be getting into the market on break of the horizontal trend line, because as you can see in this case, it's right up here, very close to going into, at this point, it came up here and it created the B1. And how do we know it's a B1? Because it broke the blue lights. It broke the blue lights. All right. So those little blue lights in there, that started the new B drive. So this is the A drive. This is the B drive. And now this one came in. And so we got to label this, right? So this comes in here. This is our X1. And then this one right here, this is our X2. Now, the problem is this market's petering out on us, isn't it? It's petering out. Okay. We all know Peter. He petered out. All right. So this is X1. This went up with our B1, and it went up and it came back down and broke our blue lights. The rotten little thing broke it. So it ended up being an X2. So now the market's coming flashing down here, and we got this natural little trend line coming in here. You can use your little speed fan if you want to. And it's coming down here, and then we got a problem. All right. We got to be mindful of this problem. If it breaks those blue lights, which it did right there, we got another horizontal right here looking for the Fibonacci bow tie. Now, this is the problem with this one. It broke the blue lights to the upside, which brought it down here. This is where you're going to get your little triangle formation. You're going to say, oh, I recognize a triangle formation, Liam. Oh, yeah, there it is. There's your little, can't draw with this new tool. Okay, it's got to go this way and then this way. All right, so there's your little triangle wedge formation. All right, and so you got your little pattern in here. That little magic blue line right there, a little black magic blue button right there. If it breaks that, then we have to, this whole thing gets screwed up, right? As long as it stays above there, this can be our C1, all right? Right there, so that's C1. So it's pulling all the way back. It's giving a big, strong pullback against this whole thing. Now, if we measured that Fibonacci ruler from top to bottom, not just the little one here, and not just from that one, but all the way from top to bottom, adding in that second drive, which is something we don't usually do. You have to kind of break the rules once in a while when the market breaks the rules. So this thing came right back down to 38.2, and notice it's riding right along that 38.2, just like a little train on rails. I think it's going to break and take off. I think that it's going to stay above that blue light, and that C1 is going to take off, and it'll probably come up and give us a little ABC pattern and BC2, C3, right? So it'll give us these little red things. It just can't break the blue lights. It's got to stay above the blue lights, otherwise it ends up being breaking it, and it ends up being maybe a D1 or a D2. It can, or a E or an F. It can do that. It can certainly do that. But right now we're looking for this to be the C1 and rising above and giving us this nice little trend in here. So I think right now this would be a good place. Now the problem is we're coming into the 4th of July, and I don't really want to buy it on the 4th of July, but this would actually be a really good place to come in here and put in an option. All right, we maybe come out here, we'd like to do maybe 100 days. But the problem is we got nobody's trading because it's this 4th of July weekend. So then nobody's trading this thing. And look at the spread on it, $160 spread, $240 spread, $350. There's just nobody here. Where'd everybody go? They're all out barbecuing. So, you know, it is what it is. We can't put our order on right now. But we think that market's going to, if you want to, you could put some shares in there. And we could come in and do that. Well, how much we want to put in there? Let's put in there. That's $8,000. Let's just put $5,000 on it. All right. So there's 15 shares. So we could come in here. And right now we just buy 15, you know, and we're going to put our stop. Where are we going to put our stop? We're going to get out if we're wrong. We don't have to. We could come in here and say, well, if it drops down a little bit more, I might want to add to it. I could put another 5,000. We go 15. We could put a limit order down here. Or we could put it down here at 61.8, just inside 61.8. And we could say, well, if it drops down here, we'll pick up another 15 shares down here. Or you could put a stop right on those blue lights and just say, well, if it comes down and hits those blue lights, I'm going to get out. So you can make your choice. Do whatever you want. That's why it's called trading. We all do something, whatever we feel happy with, whatever our portfolio can accommodate. But that 61.8 would be a great place to put another order in. We put in 15 here. We could add 15 more right there. We could be in there with 10 grand. And then maybe that market would turn and start to rally like that. That's called dollar cost averaging. And we'd have an average price here at 38.2 and 61. We'd have an average price of about the $50 or $300, $311 range. All right. So that would be a good place. Let's do that. And that's why now that I've laid out that whole foundational structure, we can go down through these real fast. All right. So we can go down through here and you can see this nice little 3-drive pattern coming down out the top. We'll just draw them in here real fast. We're not going to spend a lot of time on all of these. So there's your nice little 3-drive pattern. Drive 1, drive 2, drive 3. Now it's turned around and gone all the way back up with one big long drive. We got our second drive. So this is a B1 right here. All right, so that's B1 right there. That means that down there, where that's a A1. All right, now this little thing right here always frustrates me, but we're going to have to call that a B2. All right, ooh, I don't need all that stuff, just B2. And then right here, this is our B3. And each one of these, you'll notice these little pullbacks in here. These little red bars are kind of good little giveaways. And it's the next, our first green candle to make a new high is our next buy signal, right? So right there. You can put it right on the red if you want to, but I like to put it right there on the first green candle, make a new high. That's your buy signal. It's a B3. This one here, this is where you want to get in on a B2. First green candle, make a new high, B2 right there. So there's our A1 right there. You could put the A1 back here a little bit lower if you wanted to, but we talked about that. You could put it right on the little blue dots if you want to, whichever one makes you happy. All right. But that's the A1. So this is B2, the B3, and then we went into this little triangle wedge formation, right, which is the breaking of the blue lights, and that's where Draw it correctly, Lane. New tool. All right, draw it this way. They didn't. It's not a new tool. They just changed the way you draw it. Programmers. They're not traders. All right. Don't get me started. I sold this company. I don't own it anymore. All right. So that's the B1. There we go. So now we come in here and you break the B1 and the market starts to rally. Now, what makes the definition of an higher highs and higher lows is the definition of an uptrend, right? Lower highs and lower lows is the definition of a downtrend. So in that case, if it makes a lower high, that becomes a B2. It broke the uptrend. Now, I like to see them go red. This one didn't go red, so it really did break it. So that could technically speaking, even though it didn't go red, that could be a B2 right there. Now, we'll find out. We'll be able to see later on. You know, hindsight's always 20/20. But right now, we're going to call that a B2. And that's not a bad place to be getting in, especially where the B1 was such a short little run right here. We could anticipate another rise. Now, how do we measure that? The way we measure that, first of all, is we can come in here and we can measure the retracement that we didn't get, all right? It didn't come back even to 38.2. This market's really strong. This is, remember, these are the 100% club. So these are really good, strong stocks. There's another Fibonacci number in here, 23.6. I don't generally turn it on because I prefer to work up the 38.2 and the 61.8. 23.6, this one didn't even pull back to 23.6. So this is a little frustrating. The problem that I see with this is that this could be really strong and take off on this B1 and have another big long run. And if we didn't get in here, we'd be really sad. The other thing that I see sometimes when you have a really huge long A drive and then the B drive doesn't pull back and we don't get a digestion in here. Oftentimes what happens, the B drive is short and we get a retracement. Kind of like what happened here with this drive, okay? See how we had a long A drive, short B drive, and then a big retracement. That's pretty common, all right? That'll happen sometimes. I'm worried that that's what might happen here. We might get a short B drive only to have a big, long pullback back into this Fibonacci sweet spot in here, test that 38.2. And then that would be a really big pullback for the C drive, C1. But if it does that C1 is usually a pretty good drive. We usually get a pretty good run up out of that C drive, all right? So there's this possibility that could happen. Doesn't mean it can't just go and make a really nice big, B drive and be happy. But usually we get some kind of a bigger pullback in here because profit takers want to take profits, all right? So that's what happens, and that's what we can look forward to here on Avgo. Axon, this is the Axion. This is kind of the same. This is kind of this is a little bit of a frustrating one here. It has a 1-bar break. It pulled back and broke the blue lights. One little tick. All right, one little tick. Now that happens to be the settings. Yes, it's the settings that we have this thing. If we loosened it up a little bit, that would go away. All right, we could bring that down and we could come down and of course we could get rid of that. And there, now it's all one big drive. But that's not really fair either, is it? So we want to bring that back. That was a mistake. I hit the wrong button again. Now my defaults are set wrong. What did I have that at? Let's see. I want to be the same. I had that set at 162. Preferences 162. I tuned this. This is the parabolic SAR. So it's a little bit different than the blue light. Blue light, we want to just set to 72. We can turn that on, chart, bulls and bears, blue light, and it's set to 72. It didn't break. Bulls and bears, Donchian, parabolic SAR. Let's remove the parabolic SAR. Oh, see, blue light didn't break. But I wanted to break it right there. So I'm going to turn off the blue light. That's frustrating. So I'm going to come in here. The reason I want to use, I turned off the bulls and bears and turned on the parabolic SAR because I tightened it up a little bit because of that red bar right there. And I want this to be my defaults. No. Now I screwed it up. I keep hitting the wrong button and I screwed up my settings. 62. Now I'm going to come back here, go back to here, parabolic SAR. I want that to be 62. And I'm going to save as my defaults. Update. Okay, so that I wanted to have that break right there, or I wanted to have this be a little bit more sophisticated based on that break, but that bulls and bears is actually more accurate on here, because if you come and look, that if that doesn't break, see, that's like, this is our A1 right here. This is our A2. That would make that A3. That's A4. See, this market just kept going. That's A5. Now this is really super rare. Have an A5. So we're just going to put that one right there, and this one's right here. This is your A2. See, A1 is the blue light, or down in the valley. So that's your A1. The A2 is the little red ones, and that's why I've turned off the bulls and bears, because if you turn on the bulls and bears, it gets rid of all these little red bars, and you just look at the blue lights. But on the bulls and bears, the blue lights didn't break right here where these little red lights are, red bars are. So if we go off of this one, that would be the breaking of the blue light. So it's not A3, A4, A5. See that? This would end up being A1, A2, A3. It broke the blue lights. That's actually, I don't think it broke the blue lights. See, sometimes it's not as easy as it looks to label these things. But the real most important thing is these little pullbacks. This could be right in here. See, this could be a B1 is the part that I'm struggling with. This could be B1. What's all that stuff? B1, I don't need all that. Just this here. So that could be a B1 because it broke the blue lights. But I don't think that's a break of the blue lights. It looks like it is, but there's no blue light on the upside. So if we call that B1, this would be B2. This would be B3, which would be the top of the drive. And that would be a C1 right there. And that would make a little bit more sense. But I don't think that that's how it's going. All right. And a C1, that would have to go up there. It's just a struggle. This market's just been such a big rocket. I want to see it pull back. It's got to come back to a 38.2 at some point. It never has. I don't know about a 50 or a 61.8. That would be a big move, but that'd be all the way back to the 200 period moving average. If we draw our natural trend line right up that thing, see, we're kind of getting a natural trend line. It's starting to peak out up in there. So I'm starting to try and want to call this the peak of this first big long move, and see this thing come back into here where we can be a buyer. See, I want to see it pull back into here. This is where I want to be a buyer. So I'm not in this market. Would really like to be. I missed this whole big run. We had some of the others, right? But not this one. Here's another one doing the same thing. So we're going to, that did break. Look, on this setting, that did break the blue light right there, but it's not red. So anyway, the most important one is just you can identify the A's and the B's and the D and the C's. The little ones in between, those are just where you add on to your already existing position. And then how the probabilities are getting higher and higher. The probability of the market continuing higher gets lower and lower and lower as it gets higher and higher and higher. So you got to keep that in mind. This is your A. Oh, what the heck? I just keep hitting the wrong button, and I don't know why it puts that big old. I can't type. So here's the A1. And this is just definitely right in here. This is B1. But it's not very pretty, is it? And it's because this market had such a massive run. We'll just put it right up here on the blue light. Had such a massive run, we didn't ever get the big Fibonacci pullback, so we can't get in. If we come up here, we got to get this thing back into here somewhere. We got to get it back into the 38, 50% level so that we can buy in. I'm not buying it up there. Not after this big run like that. It's maybe if it went through an accumulation stage. If it went through a little sideways trend, this would be a little head and shoulders formation. If we got a little pattern like this, I'm going to say like this, right? A little accumulation stage where we get that right shoulder. And then we get the 3 times as a charm across the top. And it never did dip too far. Maybe on this right shoulder dip right here, we'd be a buyer. We could buy in right out in here somewhere. But we'd have to see what it looks like from there and anticipate the continuation out there. We'll have to wait and see. We may just be waiting for the 4th of July to go by and then this thing take off. All right. We have to wait and see. We don't know. Let's see what the options. See, again, nobody's trading it. Come and look at the 100-day, 141-day. See, nobody's trading. Nobody's trading any of these. They're all, well, look at all the open interest. Lots of open interest, but nobody's trading. This is the 3rd of July. Everybody's out barbecuing. Here's Carvana. Now, this one I really want to be in. I really want to be in Carvana. Really, really bad. This market is just killing it. Look at that thing. Another one right there. Another one right there. Beautiful 3-drive pattern up that thing. 1, 2, 3. And it broke right there. That's our B drive right there. B1. Ugh. Well, it broke the previous low. So this is A1 right here. A1. And then we went into the B1. And this is a C1. Ugh. I just, look at the pullback on it. Where'd it go to? Didn't even make it back to 38.2. But that's on that whole drive. If we bring this down to this one here where we broke the blue lights, we only broke it with 1 bar. I don't like it. I don't like it. If we turn on the bulls and bears, I'll bet you it's not broken. Nope, see that? Let's turn off the parabolic SAR for a minute. Look at that. That thing went up. That's all one big drive. So this is going to be A1 here. Ugh. Lower, higher, lower. Look at this. All of these. Look at this. All these highs, higher lows, all the way up to there. That's the first opportunity. Get out of there. That's the first time we got a lower high right in there. So that's actually, on this way, we'd count this as an A2. A2 is all we got right there. And then that would be a B1 here. So I trust the bulls and bears more than I trust parabolic SAR. All right. I guess that's what that one is. Let's come look at GEV. Another one that's just gone like straight up. Straight up. Look at this thing. Ah! Give us an opportunity to get in. Where are we going to get into this baby? Man alive. Holy cow. Give us a chance to get in. I want to see it pull back farther. I want to see it down here at 38.2 so I can get in. I hate to buy things up that high. That's our B1 right there. And look at 1 bar. Look at that ugly little bar right there. I hate that. 1 bar broke the blue lights. And so that ends up being a C1. You can't call that a C1. C1? Come on. Come on, guys. I hate that being a C1. Break those blue lights, that'd be a C1. Well, let's go back to the bulls and bears again and turn off the parabolic SAR. It didn't break it on the bulls and bears. So that would not be a B1, C1. That would be a B2. I feel more comfortable with that, but I hate that 1 bar that did that. Oh no, it did too break it. Look, because it flipped over to the other side. So this is right here. This would be B1 here. It is. It broke it there too. So it's a C1. That's ugly. Do you want to be a buyer right there? I don't really want to be a buyer right there. Doesn't mean this market can't go to the moon, but I don't really want to be a buyer right there. It's too high. Yeah, but it can go higher. I know it can. I just wanted to pull back farther. I wanted to come back to 38.2. That's my safety space. Hood, same thing. Look at this thing. Gone to the moon. Drive 1, drive 2, drive 3. There's drive 1. There's drive 2. There's drive 3. Let's look for this to make us a little pullback in here. Give us some. Just getting a little bit extended up in there. Wow. Look at that market. Amazing. Look at that one. Same thing. We got to get it pulled back in here. Ion Q. X1SA1. X3. So we got 3 drives. Drive 1, drive 2, drive 3. Got the pullback. A, B, C. Don't ever take an X1SA1. Low probability of success. Now we're looking for it to come back down and give us a little overall longer term Fibonacci retracement, right? All the way back to here. And there's where we want to see this thing come back down. Break that low, see if it can start getting in at 51. That's what I want to see right there. I want to see it come back down here test this 50% level. Then we can really get into this market and we can back the truck up. Same thing here. Look at this one. One big drive, counter trend, big drive, a little tiny one. I don't think that's going to break it did. It broke the blue lights, but it's not the bulls and bears. Let's turn off the parabolic SAR again. Let me come in here. I just got to. All right, there it is. So it didn't break it. So that's our B1, B2. That's a lower high. That's a little pennant in there. That's a B3. Don't want to be a buyer at B3. Probabilities of that thing giving us enough room to make any money is not very high before we get a retracement. Even if it's just a small retracement off of this one Fibonacci number, wherever that ends up, and then turns around, comes back down into the zone and starts the C drive. That's what we want to see. Oh, look at this one. We got a nice, it's ugly. Kind of a nice natural trend line. A little cleaner, not much, but a little cleaner that way. It's breaking right here. This is more of an accumulation stage that we talked about earlier. Right through there. I would like to have that one. Do you think we can get anything today? I doubt it. Nobody's going to trade with us today. 35, 178. Look at the spread on that thing. $100 spread. No way. I hate this week. I really want to buy. Well, it's a little bit of a rally. That's a good buy zone right there, Mr. MSTR. We want to buy that. Buy that one. Yeah, we can do some shares. All right. Yeah, just trade with some shares. Such a big thing. $400 a share. That sucks. I don't want to do shares. All right. We need to wait till we can get some. Let's look at a different. That's 106. What about 78 days? Anybody? $4,000, 100. Look at the spread. Oh, that one's not too bad. It's $30. See if we can get that one. $15. They're asking 50-50. I would like a couple of those. So let's do one. How much is that going to be? 50-50. 50-50. At $25. We could do 3 of these. They're not going to give it to us. Doggone it. Let's let it sit there and panned. We'll see. MSTR. This is an NVIDIA. Way too high. NVIDIA broke the blue lights. Oh, okay. Let's just turn off all the parabolic SARs and turn on bulls and bears. All right. And we're going to save chart over. Let's see. Save settings and apply settings to all charts. All right. Broke it right there. One little break right there. Look at this thing. Man alive. So you don't get with the bulls and bears, you don't get the little red bars in between. You just have to see them as lower highs. So there's one, and then that one. So there's your entry, and there's your 3 drive pattern. This little 1, 2, 3, and then we got drive 1, actually this is drive 1, drive 2, drive 3. And that makes our A1, A2, A3. A1, A2, A3. So that's A3. This ends up being, because it broke it right there. I don't know if it broke it or not. Man, these markets are strong. So that's a B1 right there. I hate it. I don't like it at all. Why? Because it didn't pull back. It's supposed to pull back at that point and give us an opportunity to get in right here. Give us at least to the 28 and then down. There's the 200. Could have come. No, too strong. Look at this thing. Unbelievable market. It's kind of a little pullback right there. Little pennant formation. You want to get in on that little, it's almost like a B2 right there. Little pennant formation. That's what we're identifying. Just little opportunities to get into these trends. Wow. Now that's more like, oh, we've already got one. Now that's a beautiful little pullback. That's what we like to see. See how it come up, pulled back right down to 38.2, breaking the blue lights. Oh man, it's picture perfect right out of the manual. Buy, buy, buy. Okay, so we did. We got one on that one. We'll see. If it comes down a little farther, we can put another one on it. If it does one of these little things, we may have to go in at 61.8 with another one. But we'll have to wait and see on that one. Palantir. Ooh, Palantir. I really want to get some more Palantir too. I have a lot of Palantir, but I want more. I want more Palantir. That's an X3SA1, X3A1S. Ooh, it's a low probability. That's why I have to sit on our hands on that one too. Ooh, look at this one. Little 3-drive pattern. Drive 1, drive 2, drive 3. Broke here. Now we're in the next drive. These are so ugly. Look at all these little blue lights in here. I want to see it give us a little bit better pullback. But look at how all the hairy tops up in there. I'd like to see this pull back just a little bit down into here, into the Fibonacci sweet spot. Then we could buy something down in there. I don't want to buy at the peaks, at these little peaks. I want to see better pullbacks. Okay. RVLV, Revolver Group. Got a nice little trend line there, nice little trend line there. It's trying to break one more time, isn't it? Look at this. Drive 1, drive 2, drive 3. And then this ugly little bottom thing started to happen. And we got a little break right here. It looks like to me it wants to go. Now, this had a slow start down in here. It's had a slow start down in here, but this is one that did 100% last year. So it's got the ability to zoom, zoom, zoom like your little puppy. It can do a zoom, zoom, zoom. And it's breaking the blue lights. It's getting ready to go. I would like to buy right there. I would like to have. Let's go see if we can do anything. I don't think we can get in today. 106. What's our nothing? Look, it's all dead. Shopify. Look at that 3-drive pattern. Drive 1, drive 2, drive 3. It's trying to go into a 4th drive. Look at this little flat thing through here. Almost like you want to go, that's drive 1, that's drive 2. We're going into drive 3 here. Like that is, it broke right there with the one little bar. We're going to merge those two and just call this the first drive. Little mountains. Remember, mountains. Just it's more important to identify them as your little mountains. So there's your first little mountain. There's your second mountain right in there. Where'd that stop? Ooh. It's ugly. Okay, we're going to look for a third little mountain right there. I don't know if that's going to be high enough to get in right now. Draw a nice little natural trend line up there. 200 pure moving averages back here. Shopify. It's a buy signal. I mean, it's a buy signal. It's just at a nasty spot. I don't know. Let's go look and see if there's any options is what we could put in here. Again, no volume today. Nobody's trading. But that's a good spot to get into. Just with this, just do one. Just do one option right there. But we got nothing. We got nothing. I don't think we could get in. I don't know how high that thing's going to go. We want to take a real quick profit. We could buy that one. We could try 16.95. 16. We got to go up to 95. Well, $20. You think we can get it? Let's get it. Oh, we got it. All right. So now let's come in here and we're going to liquidate it. And we're going to liquidate this one just with a quick little profit. We're going to come in here and say if we get, we're going to make, I'm going to run that up until we get like 10%. We're just going to take a 10% off of that one, real quick one. If it makes 10%, I have to go up. Let's go up to 18. Is that 10%? No, that's 6. Let's go up to 20. That went too high. Let's go to 18, 19. Too high. Okay, we'll come down to, you can see my little calculator right here. I'm trying to run that number right there down to 10%. We'll do 10%. That's close enough right there. Okay, $170 on a single. Yeah, it is what it is. Let's just go ahead. We're going to make that a good till canceled and place that order. So that'll just, if it makes 100, whatever it was, 10% profit, boom, take it off. All right, we'll just ride this last little drive up here just to see if it's going to pop up here a little ways and try and test that previous high. So we'll see if we can't get a little money out of that one. Sound Hound. Ooh, look at that baby. Drive 1, drive 2, drive 3 on the way down, drive 1, counter trend. This is going to be, I'm going to call this B drive right here. This is B1. B1 right there. Let's see if we can get in on that one. On that move. 106 days. Oh, there's some people trading this one. Look, they're buying that out of the money up here. I don't want that. Let's come down here. Oh, yeah, that's a good one. Let's see if we can get in there. Let's go put 3 of those in. And they're asking 261. Oh, we've even got tight spread on it. Let's see if we can get into that one. Sound Hound. That's a good one right there. I think we're going to get a little explosion out of there. Let's see if we can get another one of these, right? That's what we want. We're sitting right here. Boom, just like that. We'll just take that. We'll take that. We'll take that, and we'll put it right there. Yeah, baby. All right, let's come down here. The next one is Spotify. We're running out of time, but it is what it is. We got to take the time it takes to make money. We're just making money. We're finding some we can put into our real account. Of course, this is all our demo account, but we can go through and do all this work in here, and then we can say, I found a couple of really good ones I want to go put over in my real money account. And then you've done all the work here, and then you know which ones just go put into your real money account. That's how you do it. Not here. This is too high. See, look at that market. Holy smokes. Oh my gosh. Look at that market. Oh, that makes me cry. Why does it make me cry? Because I'm not in it. Look at that baby go. Holy cow, somebody gave that thing some Viagra, didn't they? Wow. Can you believe this? Wow. Look at all the little pennant formations. Here's one. That's not a very good one. That didn't break lows. It broke highs, but it didn't break lows. That one broke low right there. And there's another little pennant formation. There's 3 in a row. It didn't break the blue lights. So, oh my gosh, look at this market go. Holy cow. It went from $63 to $151. These markets can go, man. They can go. Look at them go. Lickety split. What are you going to do with that one, Lan? Buy in. Hell no, I'm not buying in that thing. You kidding me? Unless, no way I'm buying into that thing. I would if I could get it to pull back. If it could pull back, I would buy. I'd be a buyer at 38.2. If that thing would come back to 38.2, I'd back the truck up. And then if it came back to 50, I'd sell the house. And if it came back to 61.8, I'd sell the kids. All right, that's how we do that one. All right, toast. Are we toast? This is going through a reaccumulation. Look at this. This was a little double top, and it came down here with the rest of all the stock market as it flushed, recovered. Look at this. Wow. That's an accumulation stage down in there. Look at all the green down in here. And then we're back to green here again. Look at this. It's all accumulation. Look, this is charm 1, charm 2. We're looking for charm 3. And then this baby's going to rock and roll. All right. Let's see if we can price out some options. 106. Oh, so disappointing on the options. 141. No. How about 78? Come on, guys. Somebody's thinking that this is a good idea right here. Buying a little bit out of the money. I don't like that. I wish you'd have done a little bit in the money. $15 on the spread. I don't like that it's out of the money. I wanted to buy it down here a little bit. I much prefer down here, like right there. Yeah, right there. That would be beautiful. There's 440 outstanding. There's only one that volume traded today. This one up here, somebody 221 up there on out of the monies. Why do I want it in the money? Well, the delta's a little bit higher, so I make a little bit more money as it does rally. But I have to pay a little more for it too. I just prefer just a little step in the money. That's all. Just my preference. You can go out of the money. The leverage is a little higher out of the money. Think we can get one of these? The spread? If we go up to 5, what's the spread? 20 bucks. Ugh. 5. Let's do 4 of them. The spread is $5. Let's see if we can get it. I gave it to us, all 5 of them. Oh my goodness, oh my goodness. I'm so happy. All right. So let's see if Toast will go. Break out of that thing on the 3rd time's a charm. Don't usually like to buy on a sideways market, but I'm anticipating a breakout. So what the heck happened here? Texas Pacific Land Corporation. Wow. I think I'm going to sit on my hands on that one. I want to see a little ABC pattern first. What about this one? Targa. Rally, pullback. Rally, it's getting ready to break right here. 50% retracement off of here to here would put us up 61.8, would put us up to 187. It's trading at 174. I don't know if there's any options in here that we could trade. $1,200. Nobody trades. Volume 0. Let's look a little shorter. What about 78? Nope, nobody trading. Nope. Not a single person. Not a single trade. United Airlines. Oh, United Airlines getting ready to take off. Go to the moon. This is Charm 2. We might have to wait for Charm 3. Charm 1, Charm 2. See if we can get anything in this one. Yeah, there's a couple people trading today. Let's just put 1 on. Let's put 2 on here. I'm going to pay a little premium for it. $250. $25 a piece. Place order. We got it. Okay. Vista Corporation, not having it. Oh my goodness, look at that. One major big A drive. Look at all these little pennants in here. Little pennant formations. That's your A1, A2, A3, A4. Each one of these little pennant formations, we'll just circle them. There's one little pullback. There's another little pullback right there. There's each one of these is a little opportunity to put on a couple extra shares if you're in this market, to add a few shares. And then right here, that's our B1. So now we're going into a new B1 drive. This thing just didn't give us, none of these markets give us a pullback. None of them. Every single, almost none of them. But that's a little pennant formation right there. Okay. So that's your B1, which is a little trend line right in here. That's all it gave us. Ugh. Then it went into the B2, and then this is the B2 right there. That's a B2. So if you got shares, that wouldn't be a bad place to put a few shares on to add on to your B1 share. So there's a B2. So you got shares, you could put a few more shares on at B2, dollar cost average a little bit into your position. Make sure you take some profits off, though, along the way. What did I just do? So that's where we got to on that one. Wow, what a market. Look, this is the previous high right here. So that's where it's playing. It's playing against that previous high right there. See if it can break above it. I don't like it. I'm not going to buy into it because I want to see it pull back a little bit. I want to be a buyer, as you know, back in this region here. It already broke the blue light. I would be a buyer at 38.2 right here. If we could get a little pullback, break those, come down here. It might kind of waddle a little bit down in here, but I would look for a breakout to buy right there. Vista, that'd be really nice to get into. All right, guys, we spent a lot of time looking at this market, but now that gives us some good ideas of some things we can put some money in and make a little bit of money. Now we have to come over. Let's drop this down, and we're going to pull up our. Let's. You know what? I got this classroom portfolio. Let's just review it. I'm not going to go fill in in the interest of time. I'm just going to show you that we mid year. We started with $155,000 and we're at 22,000 trading profit, and that's a 14% return. That's not bad. That's acceptable, right? 14 if we go to the end of the year and double that. If we just did the same thing, this is June, July. We got better than that actually because we still got some that we haven't paid out. So we got Nvidia, Tesla, and Palantir that still needs to give us money. And Tesla is a big one. It'll be around $2,000. 400 for this one. I don't think we'll probably be more like this, 200, 300. Let's just put it in there. We're going to guess. All right. We're going to guess estimate. The estimate says 200 right here. So let's just estimate for right now. I'll take them right back out, but we'll just estimate just so you can see for the mid-year review. 226. And then we're going to say this one is 2330 and this one is 362. So if that's how it comes out, if the estimates are close, which they're usually pretty close, 6,700 this month. So that turns out to be a 14% UBI account ROI. All right. So on this account, we've made about 14%. That's not great, but it's not bad. It's better than the S&P. S&P usually gives you about 10%, 8 to 10% over the entire year's period of time. This one has given us 14% in 6 months. That's not bad. So what we've done here is we've got, we have to actually cash on hand. That would change. We'd have to add 2,000, 3, 6, 9, so 3,000. So we have to add 13. This would be 16. Let's just make it an even 1,700. 17,000. Okay, so that's a little better. 17%. Okay, so this month, if my estimates are right, 17%. 17% is not bad for 6 months worth of work. All right. So we started off with 100 and our initial investment was 155,000. In January, we made 7,000 on that. In February, we made 7,000. March, we made 5,000. April, we made 6,000. May, we made 10,000. In June, we're going to estimate about 6,700 because I'm not going to go do the math. So far this year, we made $44,000 on our $155,000 investment. So people who say you have to have $2 million to retire, if you could live on what this is going to turn out to be, our guesstimate for the year is $100,000. If you could live on $100,000 a year running this little portfolio the way we've been doing it, you could probably, if you can live on 100,000, which I think most retirees can live on 100,000, that's 155,000 is what we started with. So I think that there's if you're willing to be a trader and take a little bit more risk than just be a buy and hold investor, you don't need $2 million to be in your account. You can do it with smaller amounts, but you have to be a little bit more wise about what you're doing and do this little bit. You have to trade a little UBI portfolio instead of your, a lot of guys don't have $2 million. They're getting ready to retire and they're like, shit, what am I going to do? Well, you could do this. It's a little bit more aggressive. And I'm going to show you, this is starting off. We started off in January with 155,000. And so far this year, we've made 44,000. That's a 17% return on our money. That's not bad. That's not bad, guys. Now, we've been putting some of that money back in, so we haven't been living off of it. If we'd been living off of it, we would have made the 17%, but we wouldn't have because we've been reinvesting the money and we've been building our portfolio. So I can't really say you would make $44,000 that you could live off of because you couldn't have. We need to maybe do a model where we put maybe $100,000 in there and then just let it run for a whole year and see what happens without actually reinvesting any of our dividends. That would be a different model, right? That's something we should probably do. Right now we're reinvesting dividends, so we're building our portfolio and we're up 17,000. So we've only got $17,000 cash on hand. That's something we should do. We should probably do a non-reinvesting portfolio just to see what it would do. All right. So this is not real. So I'm going to exit out of this, close this, don't save, not real money, estimate. It's our It's our demo account. So now I'm going to show you, pull up my real money account. You can see how my real money accounts. And now I've been reinvesting the dividends. So I'm not pulling all this money out. I'm putting it back in and building more. So I started off in now the problem is that, see, this just calculates from January to June. But I started in July of 2024 with $476,680 in this one account. All right, in this particular account, I started with $476,000. Now these are my trades that I've been making. So this is Palantir. So this one little box right here is Palantir. This one little box right here, this is Misty. This little box here, this is Snowy. This little box right here, this is NVIDIA. And then I come down here, and this little box here, this is YMAG. This little box right here, this is YMAX. And then we've got Tesla, or Tesla, and then YBit. All right. So, and then of course we also do some trades, not just investing in these funds, but also we do some options trades in this little account once in a while too. So right now you can see that we've received total dividends, 237,000 dividends in dividends. Total infusion is 837,000. Total gains reinvested, we put 361,000. Blended income, 123,000. Deposits or profits. Now, how many of you got Pitt News Magazine this year? This month, I mean, this month. This is the Pitt News Magazine for this month. Look what made the cover. Surprise! It is mostly peaceful. All right. So we're going to come down here, and I'm going to show you an article that I want you to read. Where's Doc Brown's article? Right here. Stop muddying the waters. The real math behind dividends and ROI. This is how you, he does a good job of breaking this all down. So this thing shows you the mathematical tables that we need to be mindful of so that we're doing our math right. Okay. So that's Pitt News Magazine. And he talks about in there how to do these calculations. Okay. So we want to make sure we do them correctly. So we got cash on hand. I got $31,000 cash on hand. I think that's current. This is real money. So this is my real money account. So I got $31,000. How do I get rid of that stupid Copilot? Hide. $31,000 sitting in cash right now. Oh no, it's not, because I took some out. Had some bills to pay. So I think it's down to like 20,000. I think I took 12,000 out. So I got to add 12,000 into cash withdrawals. It's not going to change this. It's just going to change that I don't have that much cash on hand. I got 20 grand that I'm waiting to put back in the market. But you saw all those markets are all flying high. I need to find one that I want to get into. So we found a couple. I'll probably go put some more orders on. So we'll put some of this money back in. Not ready to put it back into any of the dividend funds yet, because none of those are in the position I want them to be in either. All right, so we got trading account current value, trading account total value, trading account profit and loss. That's what the number most people want to see. So how much have you made in the last year, Lan? Since last July, 476,000 is what I had in there, and I've made 274,000. So $274,000 in profit. Now a lot of that profit got reinvested, so it got blended money, got put back in to make that 274,000. I didn't make 274,000 on 476. I actually did, because as you take the profits, as we talked about in Doc Brown's article, you don't count those as your initial investments. They get reinvested, and they end up becoming the total reinvested, this total infusion number. All right, and the total gains reinvested numbers. So these become different numbers as opposed to this number, which is our beginning balance, right? So I'm up 58%, and that's not just this year, that's the whole year. That's all the way back to the last July. So the problem is, well, no, that's to June from July. So yeah, that's one full year, 12 months, 58%. Profit, $274,000. That's not bad. I'm pretty happy with that. Now, this is not my only portfolio. I've got another one that's pretty good size too, my traditional IRA. I'm not going to show you that one because it's in the process of being halfway. See, I got it halfway into my new spreadsheet. Now, this spreadsheet I gave to you guys, you get it when you get your Pitt News Magazine. It comes in the email, a link to it, so you can download it. Now, I'm getting ready to put my traditional IRA into my new spreadsheet. So I'll have that one in my traditional IRA. My traditional IRA is invested mostly in all these yield max funds too. So I'll have 2 accounts that have a high number of yield max funds in them, totaling about $1 million. So I've got about $1 million in the yield max funds between those 2 accounts. All right. So that's how it's rolling right now. So that's pretty good. 58% return on investment. This $5 right here, or 5, that's months, 5 months. So I got 5 months at this rate. If we keep going at this rate, in 5 months, I will have a cash cow, meaning that I will have made enough money, as much money as it took to replace my $476,000. So I'm 5 months away from having $476,000 and being a cash cow and having no out-of-pocket risk at that point. But I actually do have out-of-pocket risk because I took the money and put it back in. And so because I put it back in, that's what's growing it, which is why I have 58% return. It's because I kept growing the dividends. So I'm compounding my dividends, which gives me the gravy train. All right. So the gravy train is the total infusion. So you can see right now my total infusion is 837,000. My initial cash cow infusion was 476,000. So to get on the gravy train, I have 14 months. So at this rate, in 14 months, I should have the gravy train paid for, right? The total infusion paid for. Problem is, I will keep putting more stuff in, so that'll keep pushing that number out. I will probably never catch up to that number. Well, I might. I mean, if I stop reinvesting in all of these yield max funds, I could eventually catch up to the gravy train. All right. But I'm going to reset this in January, and we're going to start. I'm going to take whatever profits I have, and I'm going to take it up, and I'm going to new spreadsheet, and I'll take all those profits, and we're going to say in January, we're going to put those up as initial deposits. All right, initial deposit. And we'll work off of that, and we'll have a new cash cow, and we'll have a new gravy train. So that's how that's going to work. So monthly average, I'm averaging $40,000 a month in income. That's pretty good. I can live off that, $40,000 a month. So right now, so far, I'm up $198,000 in 6 months. All right, on a 475,000. That's less than $500,000. Put in roughly $500,000, and this model, real money. This is not hypothetical. I'm averaging a $39,000 a month monthly income, and I'm just trying to teach you guys how I do it. That's what this class is all about. I'm not telling you what to do. I'm just showing you what I'm doing. And if you guys want to learn what I'm doing, just keep coming back. Do it again. Do it again. Do it again. It gets boring sometimes. I know. Hey, he's looking at the A1 again. Oh, he's looking at the A2 again. Oh, there he is, B1 again. It's work. This is work, guys. That's what work is. All right. It's how you make money. We're not playing video games. We're trying to make money. And so you find what works, and then you monotonously do it over and over and over again. But it is what it is. I'm making $40,000 a month. I can't complain about that. On average, I'm not making that. See, in May I made $53,000. This month I made $31,000. March I made $27,000. February I made $26,000. So my lowest month was February. I made $26,000 in February. And for those guys of you that are new, the reason these are purple is because I say that's my taxes. I'm going to have to pay 2 months worth of taxes on my portfolio. So that means $30,000 on average. If I'm doing averaging $40,000, I got 2 months. I'm going to pay about $80,000 in taxes this year. That's not going to be a fun check to write. But I have written much larger checks in the past to Mr. Uncle Sam so that he can go over and bomb, Iran. All right. Okay, guys. Guess we'll end with that. No, I got a Sunday school lesson for you. Don't run away. Sunday school lesson. Trading is a game of strategy and wit, where you must think several moves ahead to outwit your opponent, who's doing the same to outwit you. All right. For every winner, there's a loser. And if somebody takes your piece, then they won. You take their piece, then they lost and you won. So it's all a process of taking somebody's money. All right. That's what we're doing here. That's why they call us capitalist bastards. because we're in here taking other people's money who are actually working for it. So school teachers, firefighters, they come and put their money in here. And what do? Oh, thanks. Appreciate it. Thank you very much. I'll take some of that. You capitalist bastard. I didn't invent the system. All right. We just live by it. Okay, guys, if you guys have any questions, let me know. And I will let you out of here. Media assets. So we got to listen to some of these fun media assets. How about Bill Gates?
Yeah, when I heard Elon talking about Pitt News Magazine, I called in and got a lifetime subscription, myself, of course.
Yep, see that?
Hey, it's Claire. If you love trading tips with a side of sarcasm, hit that follow button and subscribe to Pitt News on Air at pittnews.com. I'll be here every week, unless I blow up my account again.
Got a little late.
Hey, Land Turner here. I got a hot stock market tip for you. Subscribe to Pitt News Magazine. You can thank me later.
I love these little things. Claire sent these over.
If you haven't subscribed to Pitt News Magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
All right, guys. Claire got a raise. I wouldn't call it a raise. She got roped into being the assistant editor-in-chief. Assistant editor. She's not the chief. She's the assistant editor. So she's got a bigger role, and you probably noticed that she's been doing more in the magazine. So she takes care of the magazine more than I do. So she does her little podcast. Don't forget to go and register for her podcast. And then I guess today is over. Just sitting here. I ain't got nothing to do. Go put my orders on. I don't want to really put my orders on today, though, but I guess there's a couple of them we need to go put on, don't we? Probably a couple of them we should go put on today so that when they can rally really hard next week, we'll be in before the rallies. All right. I guess that's it. Unless we want to sit here and watch advertisements a little bit more. We'll end on here. I got two more ads. Yeah, I don't know. Yeah, let's watch this one.
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pittnews.com. That's pitnews.com. Pitt News Magazine. News your way.
Yeah, it was fun. What about this one? We all like to end on Claire.
Hey, Claire here. Guess what? Mr. Turner handed me the mic. I've now got my very own podcast, Pitt News on Air, your new weekly hit from Pitt News Magazine. Join me every Wednesday for stories, interviews, and a little behind-the-scenes scoop. We're live on Spotify, and yep, now on Apple Podcasts, too. Visit pittnews.com to follow. Come hang out with me and the gang. We're all there. Jake and Lena, of course, Land Turner, David Duty, Dr. Scott Brown, Jordan Black, and even Aiden shows up on occasion. We're having a world of fun. Don't miss out. Pitt News on Air, because news should never be boring. It's where your trading friends are. Follow us wherever you get your podcasts.
All right. That's what we got for you today. If you guys have any questions, let me know. Leave a comment in the comment section and give it a little thumbs up. It's always nice to see thumbs up. And I guess we'll go. I'm going to go get me some breakfast. See you guys next Tuesday. Have a good holiday, good 4th of July, and we'll see you next Tuesday.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.